Money FM 89.3. Best of breakfast. The U.S. Market Update with Money FM 89.3.
Good morning. Welcome to the U.S. Markets Wrap. And we've got a pretty subdued session overnight, a bit mixed as investors digest cautious commentary from Federal Reserve Chair Jerome Powell on interest rates. Concerns also remain over the direction of the U.S. economy, as well as the ongoing tariffs, plus the possible escalation of a global trade war. So looking at S&P 500, we've got a narrow gain of 0.03%, closing at 6,068 for the broad index. The Nasdaq Composite underwater by 0.4%, and that's a reflection of most of the big tech names dropping, though we did see Meta Platforms climbing for a 17th straight day. The Dow Jones Industrial Average was up 0.3% to 44,594. That's up 123 points. Among the top movers, we've got Apple gaining 2.2% after a report that the company is partnering with Alibaba to develop artificial intelligence features for iPhone users in China. For more insights, we are joined by Rick Polsinello. He is the Senior Market Strategist at Franklin Templeton Institute. Rick, good morning. Thanks for joining us on the show. How are you doing?
I'm doing well. How are you, Ryan?
I'm doing great as well. Thanks for joining us again. Now, let's jump into the latest in the markets. And it looks like Jerome Powell is back facing Congress with his routine testimony. What do you take away from his latest comments where he's pretty much signaling that the Fed does not need to move quickly to ease monetary policy?
Yeah, his comments today aren't that surprising. So as you mentioned, he's in front of the Senate here in the U.S. Both today and tomorrow, in front of two different committees, I guess. And really the overarching message remains the same over the last couple months. I think they're in no hurry to cut rates with where we are right now. Obviously, you know, our central bank tried to get a little fancy, the Fed, in that they have a dual mandate, right? They have full employment, low unemployment, as well as price stability or inflation. And I think it's just they're kind of in this time where, you know, the market expects right now, based on pricing, one or two cuts each of 25 basis points for the balance of this year. And I think just given what we're seeing right now in the market, it's sort of tough to justify that, right? Unemployment is low at about 4%. Inflation or core inflation, core PCE, has been pretty sticky in the high 2% range with a 2% target. So not anything too surprising. And I think tomorrow we'll see much of the same.
Yeah, we did see tech under pressure to some degree. What's driving that pressure?
I can't exactly say. I mean, I think if you look back over the last year and a half, obviously big cap or even mega cap tech, especially those with an AI focus, some of the best technology companies. If you look at the valuations and what they've done, I think the market at this point, you know, not necessarily they've done anything wrong. But we talk about price to perfection, maybe not price to perfection, but price to doing very well. Right. And I think some of the investors out there, just given the uncertainty and some of the volatility that we've seen, obviously the new administration, I think maybe it's just a pause for technology stocks here just over the short term.
And of course, talking about the U.S. economy, we did get earnings underway in recent weeks. What have you been taking away from some of the commentary when they talk about where the consumer is, where the outlook of the economy is going? What's your feel of where the companies are going to be looking like in coming quarters?
Yeah, so in terms of cap weighting, about 80% of the S&P 500 has now reported. And right now, the numbers are about 5% in terms of revenues up year on year. Earnings are about twice that. They're between 10 and 12%, depending on how you look at them. And kind of in line with what we've seen in the past few quarters, about 75% of the companies that have reported so far are beating on both the top line and the bottom line. I think with the guidance has been mostly positive, but some of the companies have been a little bit measured in terms of their language, which, if you think about it, it makes sense, right? Just given all the uncertainty out there, especially with tariffs, you know, you could see why companies right now in terms of CapEx spending and, you know, kind of making their operations a little bit bigger, some are taking a little bit of pause here. And I think, you know, they're obviously going to try to beat earnings next quarter, but I think they're trying to kind of keep the expectations of the analysts right now sort of in check.
All right, Rick, talking about being priced to perfection, I'm wondering where gold is going from here because we've just seen it hit record highs of 2,900 plus per ounce. And year to date, it's up some 10%. In the past week, it's up 2%. And it's so far outperforming the indexes. Is this going to be another banner year for gold?
It's very tough to say, Ryan. I mean, typically I've looked at gold as really, a safe haven type asset where you're sort of protecting yourself against an inflationary environment. But again, I think we're in a tough spot, right? We're trying to get inflation or core inflation from the high twos down to that 2% Fed target that they've talked about for, a decade or 12 years, I guess, at this point. But if you look at the market, last year the S&P 500 was up in excess of 20%, same as the year before. But yet you've seen gold in the last, let's call it decade, up about 3 times. You mentioned it hit over $2,900 per troy ounce earlier today. It was at just 1,000 10 and a half years ago. So, that being up 3X, I think investors obviously have, some reservations out there about the trade conflicts, the potential for those going forward, and that could stoke inflation or even could sap economic growth. I think to expect gold to kind of perform the way it has over the last few years is probably not realistic at this point. That being said, any more uncertainty, any more volatility that we see across the market, you could see investors continue to go into gold as kind of that hedge on uncertainty, volatility, and inflation.
Yeah, that's a good point because we are watching very closely where rates are going. So I'm wondering as well, to what degree do rates still play a part in where gold is playing in the coming year? Because you've got, I guess, other reasons that folks are jumping on board for a piece of the action when it comes to gold.
Yeah, I mean, I think if you look at the rates right now in the U.S., right, our 10-year Treasury is yielding, let's call it 4.5%. And Franklin Templeton Institute is only expecting probably 2 interest rate cuts for the balance of 2025. Obviously the language today, and not just the language out of Powell, but also New York Fed President Williams, is really one where, if you listen to it very closely or if you look at the latest Fed minutes or the statements, it's all about eventually and gradually. And, I think when we look at that and we say we're at 4.5% on a 10-year Treasury yield, you have to put that in context of that's obviously on the fixed income side of the ledger, but gold being kind of that safe haven asset. There's a relationship there, but it's really tough to say going forward what that relationship is going to look like. When we talk about rate cuts, that's obviously Fed funds rate or the overnight bank lending rate. We think 2 cuts, that could get you down to, the high 3% area by the end of this year. Obviously get the yield curve that has at least some steepness to it, right? We're not going to be inverted the way we were, call it 6 months to 9 months ago, which, we were that way for probably a year and a half at that point. So we look at gold and we look at the Treasury yield. Again, we don't think it's going to move too much, the 10-year yield by the end of this year, probably, again, 4 to 4.5%. The front end of the yield curve we think could come down. And again, gold, very tough to say because we have been in a risk on environment, and gold has done very well. And again, traditionally, it's been more of that safe haven asset where you see folks kind of pile in as there's a lot of volatility in the market, and usually as stocks go down, which is not really what we've seen.
All right, let's talk about in the coming quarters, and we've got a good overview of where things are right now with Rick Polsinello. He is the Senior Market Strategist at Franklin Templeton Institute. Rick, thanks so much for your time and insights today.
Absolutely. Thanks for having me on again, Ryan.
All right, catch up again soon, Rick. Stay Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.